Hey everyone, welcome to the office hours. We're gonna let a few more people go ahead and trickle in here. I see we already have a couple of you. We're having a nice sunny morning here in Texas. I understand it's not the same in Illinois right now, unfortunately, so maybe that's good for a webinar. Right.
Well, I took off my skinny glasses, so it doesn't look like I'm looking up at anybody.
Yeah, you got a little bit of honest feedback on that one.
Oh, yeah.
Our clients know us well if they can give that kind of feedback.
I think that was funny. That was one of the few items of feedback we got is Paul's glasses just aren't acceptable for presentation mode.
Yeah, and these glasses are probably all of about $3, but
No comments on my hair though. I'm gonna go ahead and let it keep growing out then.
Oh,
Maybe until my wedding. I think Connie would be happy about that.
that'd be great.
All right, well, we got 8 of our 10 registered attendees, so we're gonna go ahead and let the last couple, maybe give them a couple more minutes, and then we'll go ahead and get started.
I think we can go ahead.
Okay. Yeah, well, I think we didn't actually have any questions, so I guess we've been doing a pretty good job answering them in in previous office hours. But if you guys have any questions, go ahead, and we'd love to see them. Getting our Q&A feed here. But I think the first thing that really kind of everyone's wondering about is, how can we have so many people unemployed, record numbers looking like depression type numbers, and then the stock market is still up, 35% from the bottom.
Yeah,
I think
go ahead.
I was going to talk, but I think everybody's here for the big dog, so I'll defer to you.
No, go ahead. I think everybody should give their thoughts on it because nobody's going to, not even within the company do we always have the same. We follow the same rules and the same principles, and we're all on the same page. But we may have different theories as to why what's going on is going on. So go ahead, Ryan.
Yeah. What I was going to say is unemployment's looking backwards. It's things that have happened in the past, whereas the stock market is always forward looking and also pricing in information that happens second by second, minute by minute. So it's very easy for the stock market to start looking and moving positively, whereas it's a lot harder for firms who have laid off employees to then put people back into the workforce at any kind of similar rate. So there's a very real expectation that there should be a disconnect when we start getting positive news. And when I think yesterday the news came out that there's a positive drug treatment that was available or is in initial rounds of testing, the market took that very positively and it moved upward. But of course, the employment rate is still going to lag quite a bit until we really can start moving again in the economy. So that's my 2 cents on it.
Well, we certainly probably for everybody watching this today probably saw the worst unemployment numbers that you'll ever see in your life. Chances are, if history's any guide. So, I mean, the market knows that, okay, those are the worst numbers we'll ever see, which means the future is probably not quite as dark. And Dave, I know you study this. You've talked to me quite a bit about it. It's kind of how it's really a spectrum issue going on. It's not always so binary, black and white as what's going on in a stock market at any given moment. You want to talk about that?
Yeah, and I think, Ryan hit the nail on the head where, you look at it, economic data, that's always backward looking. It's a snapshot in time. And I'm going to sound like a nerd here, but when you think of like what the value of a stock or a company is, it's the present value of its future profits or earnings, basically future cash flows into perpetuity, kind of forever. So I think the example you've used before, Dad, is like, okay, if you have one bad year of crops, if you're a farmer and you have a poor yield, that doesn't mean your farmland all of a sudden is just worthless, because okay, well, year 2 through, infinity is still could be good. And I think that's kind of one thing to keep in mind is, yeah, we're going to have some terrible economic data coming out. We already do. But what we care about for companies is what is their earnings? What are their earnings going to look like over the next 100 years when we're looking at stocks or more? So that's why you see that disconnect. And then I think too, people always forget that the market is pricing in expectations for the future. So like an example, my wife was just talking to me and she doesn't have much of a finance background, and she said, well, don't you think like once they open things back up and maybe there's new cases of coronavirus, they spike up because they open things back up, the market's going to tank? And I said, well, not necessarily. It could, but it depends. If people already expect that outcome, that, hey, we might have an increase in the number of cases. If we have an increase, but it's not as bad as what the market already had priced in, you could actually see the market go up. So that's where I think sometimes it messes with people's minds when they see the market do something that's seemingly disconnected with what's going on currently in the world. A lot of times it's, hey, maybe this is bad news, but it's less bad than what we thought was going to happen.
And over a really long period of time, we always think the stock market and the economy are connected. They are over one's lifetime. They're quite connected. But there's always periods of disconnect. This is one of those periods. So it's just everybody has their own expectations, and that's what markets are. Markets are billions of people with overlapping minds trying to determine what their version of the future looks like. That is their expectations. And nobody's are going to be right. Some are going to be more right than others, and those expectations are going to change. And when the expectations go wild, stock prices go wild, and that's why we get periods like March when we had extraordinary volatility. That's because everybody's expectations at any given moment were swinging wildly. So and it would be a strange world if everybody knows we're going to have 23 million people unemployed within maybe 1 million people, and then the market falls. That would be truly an inefficient market. And so I think that's just, it does show you how hard it is. I just wrote a News Gazette column, and I kind of went back to 2008, 2009. I think we even talked about this a little bit last time. But and I'm not going to say it very much. If we wait till things look better, that means when prices are higher to get back in. So there's no way to gain any timing advantage over one's expectations, that's for sure. I think one useful thing, if I'm a client and I'm pulling money out on a monthly or periodic basis, on a regular basis, and I have this plan, and this plan has, nobody knows, there's no facts about the future, we don't know what returns are going to be. But I can tell you over the last 20 years, this has been one of the lowest 20-year returns for the broad stock market, sub 4% per year. And I don't have any clients the ones that have been with me 20 plus years, whose plans aren't materially better than they were expected 20 years ago. So we've had subpar returns for the broad US market, yet every client's plan that I could think of is significantly ahead of what they had hoped for 20 years ago. And that's the important part. As much as advisors and pundits all talk about, here's what's going to happen in the future, I think it's better to say we don't know what's going to happen into the future, but we can give a pretty good estimate of what returns might be from a broad distribution. We don't know where we're going to come out. And as long as that distribution of returns is sensible and has basically, it represents economic sensibility and reality, a plan shouldn't really have any significant long-term problems when returns are subpar. That's the whole point. We don't know what returns are going to be. So when we're telling people what they can spend, we dragged that through those, we stress tested that plan through returns worse than over the last 20 years. And that's why it's so conservative on the front end in particular.
Speaking of people's expectations for the future, I think we've covered that quite a bit. One of the things, that gets baked into the cake are people's concerns. And we just had a question roll in, kind of half tongue in cheek. Are we in for hyperinflation due to all the money being released into the economy? And then it follows up with, should I buy a wheelbarrow for money like in 1918 Germany?
Well, I've studied this a lot, and I hear that a lot. I've been hearing it, by the way, for 36 years. That we're going to have inflation or hyperinflation. And I know the client's probably sort of kidding about the hyperinflation, but it has happened in the historical perspective of the world. There have been mistakes where it led to atrocious and devastating inflation. But when you see these numbers of 6 and 7 trillion, that's literally not money that's going into the economy. That's that most of it, frankly, probably 2/3 is really just the Treasury and the Federal Reserve cooperating and supporting markets. And they're supporting it in a variety of ways. But essentially, now they're even willing to buy securities to make sure that there's liquidity and all these things in the market. Well, that's just a government borrowing trillions to invest in trillions of dollars of assets. Yeah, we all might disagree on what the outcome's going to, the investments they're buying, whether they're more risky than they should be. But just like 2008, 2009, I heard the same things because the Fed's balance sheet went up by about $4 trillion. But that really wasn't $4 trillion going directly into the banking system, through the fractional banking system, and then the banks lending, $9 for every dollar of deposits. Didn't happen. All that money that was printed, theoretically, stayed in excess bank reserves. And the reason they stayed in excess bank reserves then is for the first time the Federal Reserve paid interest on excess reserves. So anyway, I knew 2008, 2009, I had zero worries about inflation, above average inflation. I don't really, probably a little bit more what's going on today, the sheer magnitude of it, that some of it is going to find its way into the banking system and kind of stimulative. Sure, it probably is going to lead to maybe, but they may have a hard time keeping their inflation below 2%, but it doesn't mean it's going to be 7 or 8 or 9%. I don't see anything, not that it's not possible. I've seen nothing when looking at monetary policy, and I've studied it a lot, give me this, we're having hyperinflation and run for gold and stock prices are going to collapse. I think that's a mistake. By the way, clients, if inflation is above average, we're prepared to deal with that. In all my testing and back testing of plans, we should be able to materially capture whatever the inflation rate is within reason. We should be able to maintain significantly our standard of living. And one of the things you need to do if we go into above average inflation, I think I've talked about this before, is you have to entertain the idea of a little less fixed income and a little more allocation towards the great companies of America and the world. Because at the end of the day, over time, these companies have the ability to increase prices and to increase dividends. And that's a better inflation fighter than fixed income tends to be. Okay.
Well, moving from the national economy and concerns there to really more the local economy, we just had a question about the local impact if the U of I doesn't open up on campus this fall. I've seen that there's already a couple businesses closing down. I saw that I think the Still is not going to open back up. So he mentions business failures, but also concerned about property values falling as well.
Well, if I'm a real estate developer, even before this crisis, I know quite a few of the developers of those big, tall, giant buildings that have been built over the last 4 or 5 years. A number of them have said if we had known everybody else was going to build them, I might not have built one themselves. I think I've talked to one person who should know at the University of Illinois, who's pretty plugged in, thinks the number of international students will be a fraction of what they've been historically. Now that may or may not be right, but obviously the University of Illinois in this town is a huge employer. It's a big engine. And if there's a problem and, and there's 10 or 15,000 fewer students, I don't know if there will be or not. I think it has some type of rippling effect. Bankers will be worried. I think there's going to be a lot of people in every town whose fortunes are going to change. That's what I would say. And obviously real estate may be overextended related to the university here, but every university town in America is worried about that because think of the essence of a university town is that's one of the primary engines of the local economy. So I'd be a little bit worried if I was heavily invested in real estate that's dependent on students.
Yeah, I was just going to say that would probably be very specific to campus rentals and commercial real estate closer to campus. I know there's sort of a trickle out effect, with the whole economy when students are there. But I also have heard that housing values, everyone kind of expected housing values to drop. I can only speak for Texas, but they've held up pretty well so far with the coronavirus. Have you guys heard anything about Champaign or Illinois and how the values have been there?
I think it's a pretty broad brush. Houses in the 2, 3, 350, 400, you know, they're selling very quickly from what I can tell, just looking at, you know, when I drive around. The $1 million houses, well, now when you take a town like Champaign, $1 million house is probably pretty close to $30,000 in property taxes. And I think after 2008, 2009, the appetite, there may be just as many people that have the ability to buy them, but the appetite lessened, I think. And I think there's some exposure at the high ends, but nobody's really talking about a housing collapse. If anything, certain segments don't have enough houses being built.
Yeah, that's been the conversation here. I have a friend who's a realtor here, and she just sold a house, and I think 2 days above asking price. So, yeah, I mean, things have held up pretty well here. If anything, I think people have seen the value of having a house. You know, I'm certainly glad, although I sometimes complain about the upkeep, you know, definitely glad to be quarantining in a house instead of a 700 square foot apartment. Sorry, Daniel, I know that's your existence right now.
I feel you.
Yeah, and one of the things we didn't mention earlier, I just don't want it to go unsaid, is the Federal Reserve has thrown a lot at this problem. And that's probably going a long way to solve some of the potential financial issues that a lot of people were worried about. It's an old saying, don't fight the Fed if you're a stock market investor. And boy, they're coming out and doing a lot of stuff. I think that's even supporting, in some ways, the local economies, but more specifically the housing market as well. That plus you can borrow money at 2.75% for 30 years. To the extent people feel secure about their job. Nobody knows, right? We just need a plan that can handle a wide distribution of outcomes. And that's really what we're focusing most of our time on is, and you guys are still from the collectively looking at all the client plans as a universe. Would you guys fair to say that they're all in a lot better shape than they were on March 23rd? And in fact, back to probably in the comfort zone, et cetera?
Certainly.
Yeah.
Yeah. Speaking just from I know each one of us went through every single one of our financial plans for each one of our clients and did a quick pulse check and said, all right, given the state of the economy, where the stock market is, and the goals for each one of our clients within each of their plans, there was a decline back in the March timeframe. But now just speaking about my own clients' plans, we're in that comfort zone again, and that's simply just by the bounce back. And it's all by design anyway. We know that there's going to be times like this where the plan is going to move down and move up, and they're balanced enough and they're conservative enough on the front end to expect these types of declines without having to make immediate change to spending. So I think for me as a younger advisor, if I can take my hat off as the advisor and just kind of an observer for a minute and just say, as a younger advisor who's dealing with the first real major decline in my professional career, I was happily surprised to see how a major decline in the stock market has minimal to no impact on our clients' plans based off the conservative nature of our planning process. I would be surprised if you guys didn't agree, but I just thought it was kind of interesting to see. It takes a really big whack in the financial market, a prolonged decline, I think, for our plans to really have to make many major changes.
And Daniel, you deal with a lot of younger folks through our co-pilot.
Mm-hmm.
What's their behavior like? Have you any themes there?
It's kind of interesting. I think it depends on what they've heard from their parents or people around them, because I would say half of them have emailed me and go, hey, I got I got some extra cash. Should I invest it now? And then the other half are like, should I wait for things to get better? But both of the times, I think just from the stimulus check, they've had a little extra cash, and half of them think they should wait, and the other half feel like it would be a good time to invest. And it's kind of interesting because some of them are children of clients, and you can tell that their philosophies match up very closely.
Yeah, just my personal experience as well. I'm not traditionally the advisor. I'm not, in the trenches every day doing plans like you guys are. But, with this whole market turmoil, I've actually had quite a few of my friends and my fiance's friends reach out to me And it's just kind of brought up the point that, you know, investing can seem really easy and seem really on autopilot when things are going well. But then all of a sudden, you know, people see their account balance decline and they kind of start to ask questions. And I've just been really surprised, you know, like, hey, how come you people didn't, you know, ask me about this stuff 5 years ago? You waited for a little bit of turmoil. But I think that's been kind of an interesting thing. People who have been seeking advice that weren't originally.
And I think, you know, I've noticed as my clients get older and I get older, one thing I hadn't really thought about that I think a lot about now is you take a couple that are clients in 2008, 2009 that were in their mid 70s. This comes along, they're in their mid 80s. All of a sudden, that's a little bit different thinking process and a little more concern. So I think one of the things I'm going to focus on a lot, and the guys and I will be talking about a lot, is to make sure when we're looking at clients' allocations that we're not reaching for returns that we may not need. And the only way you do that is to increase your stock allocations. It's not a market forecast. It's not something I'm thinking about radical changes, but just client by client, do some extra thinking about the allocation. Could we get to the same place with, I'm going to say less risk. Most people that know me know I don't like to think about the stock market as being risky. I think of it as fluctuating and being unpredictable in the near term. But I think one of the things that we're going to embody in our practice is our clients get older, we're going to be more sensitive to fluctuation and allocation decisions. It's not age discrimination. It's just based on what I've noticed that the stock market declines for part of their portfolio seem to be more bothersome to people in their mid 80s. And it only makes intuitive sense, of course. And so I think that's one of the things the guys and I will be discussing together and then with each of our clients.
Well, go ahead.
I think one other thing to note is that people, I think, tend to forget that 30% of every dollar of your stock portion is outside of the US. And that's, during times like this, that's kind of important. I know the coronavirus is impacting everything, but let's say you're worried about hyperinflation in the US and things like that. That's why it is important to be globally diversified. And these are just times where it shows that it's important to, and you can actually take comfort that some of your money is outside of the US.
So it hasn't been delightful for the last 10 years, right, Dave?
Right.
Yeah, that was.
You have a 10-year time cycle.
That was one of the things we were talking about right before this, was just how long you can go through periods of underperformance relative to a benchmark, and just how I've noticed, I think people are really quick to draw conclusions from historical performance. And recently, you know, the NASDAQ, the biggest, especially tech companies, but biggest companies in the US have just been trouncing everything. And I'm noticing more and more people, the longer this goes on, are kind of jumping on that bandwagon. And you can spin a really nice story for it too. It's, oh, well, they're less affected by, the coronavirus and shutdowns because they can do things remotely more easily, and all that stuff may be true. But I've just been noticing, like I said, more and more people chasing after that performance and starting to give up on some of the things like international diversification, value stocks, smaller companies, because it's been 10 years now where the US, particularly the biggest companies, have been doing substantially better. But that approach to investing can end so poorly. And, I was also talking about how if you just went back 10 years, you would have drawn the exact opposite conclusion. You would have said, man, the S&P 500, the big companies in the US, these are garbage. I'm going to get out of these. It's all about international and small and value, because over that 10-year period from 2000 to 2009 is the exact opposite. And sometimes I think people think that 10 years is a long time, because in human terms, it is a long time. It's like more than 10% of a typical person's life. But from an investing standpoint, it's way too short to draw any conclusions. And a lot of times things do kind of revert to the mean a little bit, and something that's been doing well and something that's been doing poorly, it's almost about to flip flop right at the time you're about to bail on the thing that's been doing poorly and jump into the thing that's been doing well.
Well, yeah, and there's been a lot of articles lately about, as Warren Buffett, who most consider the world's greatest investor, literally, it's all, maybe it is almost age discrimination at this point, but it's basically the old guys lost it. If you look at the Berkshire's return, Berkshire Hathaway's returns, you know, relative to the Standard & Poor's 500 index, it's at a 5-year low on a relative basis. It's like, wow. How often does Warren Buffett go through a 5-year period where it's just horrible compared to the Standard & Poor's 500 index? Well, you can go back to the end of 1999. It was even worse. And back then, well, the old guys lost it. Even back then, they thought that. And so it makes me wonder, either maybe this idea of value investing maybe has permanently changed. I doubt it, but I don't think I would bet against Warren Buffett. And in many ways, we share a lot of the same philosophies when it comes to investing. I'm not going to put myself on in his category, but the point is 60% of our our portfolio allocation to stocks is tilted heavier towards value stocks. And certainly that's been a drag for the last 5 to 10 years, but I've been through that period. I've been through a period when it was just as long or longer and it was much worse, only to see it reverse course in the last decade when we really needed the help the most. In other words, 20 years ago, it's hard to imagine, you know, at the beginning of this meeting, I talked about how if you look at the 20-year annual compounded return for the Standard & Poor's 500 index, which is basically just the largest companies in the US, it's just one asset class. It's sub 4%. It's in the around 3.5, I think, 3.5 to 4% range compounded. And we always think in terms of, well, big company stocks compounded historically at 10%. And a lot of people would go back and say, well, what you pay for something matters. And in 2000, you know, you would have wanted nothing but large growth companies. And those things have done horrible for 20 years. In other words, you had to pay really high prices for those. And again, like Dave was saying, and it was all based on hindsight bias. Look what's happened over the last 10 years. Let's load up on the winners and overpay for them. And they've overpaid so much that they've really, anybody who did that and just invested in the Standard & Poor's 500 index in 2000 has really had really low returns and really low returns over that 20 years compared to a globally diversified portfolio. It's just that any given 5 or 10 year period, they seem to switch places. But the person that takes a global diversification theme has fared much better over the last 20 years.
I think the thing for people to keep in mind too is there is no strategy that does the best all the time. You know, even if you had a strategy that you knew was going to outperform over, you know, a really long period of time, it's going to go through periods where it substantially underperforms, you know, other asset classes. And you have to just kind of accept that and realize that you're never going to be the best performer in every single year. And that's why you diversify. Since we don't know what the best performer is going to be in any given year, we own a bunch of different asset classes so that we're always going to own some of the good stuff, but we're going to own some of the stuff that's not doing as well right now. But when you combine it all together, it smooths things out a little bit. So you're not living and dying by one company or one asset class.
Yeah.
One thing.
I was going to say, it's a quick comment. Give me an investor who's globally diversified, who ends up with average returns, but behaves properly, over someone who's chasing performance, maybe gets lucky, and just luckily chooses always what's performing well, but yet that person can't behave properly. I'll take the former as opposed to the latter. The beauty of planning is it makes returns almost irrelevant, which may sound really strange. When I tell people that as a financial advisor, that it's not really investor returns that matter, it's investor behavior. Like I said, look at the last 20 years, below average returns from what you would normally expect if you just, you know, look at long-term returns. But I knew building plans 20 years ago that I didn't know what returns are going to be, as we talked about earlier. Yet every client that just kind of was able to ignore the 3 and 5 year periods where some of the stuff we invest in doesn't look as good as some other stuff, And I'll say, and you guys probably will agree, we have very few performance conversations with clients because, as I said, whatever the performance has been is irrelevant. It's where is the plan? Are we in the comfort zone? Can we continue to spend what we're spending? And are those decisions based on good simulation that's backed with economic reality? If you could do that, really, you know, I had a client who died not too long ago, but he said, you know, I go to coffee with a bunch of guys kind of my age, a bunch of just old guys. He goes, it seems like on a day-to-day basis, what the stock market's doing is kind of defines everybody's temperament. He said, I never really even think about it or worry about it or even look at it. And that's the key. If you have a good plan, it provides a lot of relief through periods when it's uncomfortable.
That's exactly what I was.
Oh, go ahead, Ryan.
I was going to say, that's exactly what I was going to echo off of Dave's comments. Dave, when you were just explaining the fact that like there's always going to be certain parts of your investments that underperform or overperform relative to others. And what I was going to simply mention is not only is that to be expected, but that's all you need when it comes to achieving your goals within your plan. The plan is not based on every one of the investments outperforming everything else at all times. The plan expects that there's going to be high performers, low performers, and in the aggregate, in total, when it's all put together, you don't need everything to overperform. You just need to get basically general, average returns, maybe sub-average, to have a very successful lifestyle in retirement. And the comments, Paul, that you just made, just about performance, and that is rarely a topic we discussed. That was, in fact, an email that I had written to a client yesterday, when I haven't even talked to you guys about, but the client said, I wish we would talk a little more about the 6-month, 1-year, 5-year, and 10-year returns relative to the benchmark. And I went through the whole conversation, Paul, that you just went about why we don't do that, because it's all plan driven and not benchmark driven. And I think that's easily something that we as advisors take for granted because we're raised up on it and we've studied this so much. But it's easily, or can be easily, forgotten for our client side of things, that we're almost programmed to say, what are my returns and is it doing better than something else? And in the client's head, it's like, if I don't have the best or near the top, then I need to make a change.
Yeah. My daughter, for example, married a sub-average guy. And
and she's doing great. Look at her.
Well, I think that's what gets kind of like tricky, is when people are solely looking at their investments, is that sometimes you can start to, like, reality just isn't quite there of like, well, I already won the war. Why am I taking on this extra risk? But it's easy for people who are only looking at their investment returns to be, well, I want a higher investment return. I want a higher one. And then something happens, or they're reaching for returns in the wrong way. And then they do something that permanently impacts their lifestyle, which is the important part, And then,
Andrew, do you think if you took a new client on, is there any wisdom maybe in saying, well, if they feel like they could take on they're going to use the word risk, but take on a lot of fluctuation, would there be any merit to saying, let's get through the first bad period first and let's see how you feel after that?
I think yes, because I think we've actually seen that with a couple new clients as we kind of determined portfolio asset mix, 60% stocks, 40% bonds or whatever. And people now came back to me during this decline and said, hey, I'm getting kind of old. I feel like we shouldn't be 60% equity. And what you're really finding out is when we brought them on, returns were good. And now that returns aren't so good and they saw their portfolio decline quite a bit, now they're not feeling the risk so much. They don't like the fluctuation. And what you figure out, and studies actually show, is that people like to think that they can handle more fluctuation and risk than they actually can. So it's nice to start conservative. And if you go through the first decline and you go, you know what, this decline didn't affect me at all, and I feel like I could still be that higher equity allocation that we talked about, then we can look at it. But until then, I feel like you need to err on the conservative side.
Okay.
Well, guys, I know we just spent a bunch of time saying that, short-term performance isn't super relevant, but something that I think would be getting a lot more concern in a normal year, had this whole coronavirus thing not be going on, is the upcoming election and the possible impact of that election, during the next few months and maybe even after that. That question just came through here, and I think that's one that a lot of people would have. It's not getting as much attention because there are so many other concerns right now.
Anybody want to take a stab at it?
Yeah, I'll do it. I'll give it my concise answer. We don't know. I mean, if we're being honest, we don't know how the market will react to the election or the results one way or another. And I think that's the only honest answer. We could sit here and we could speculate on, different scenarios and how the market may or may not react, but we're just guessing at the end of the day. And when you see people on TV doing the same thing, that's all they're doing is just guessing. No one really, and the example that I use is, you go back to when Obama was first elected, especially that first time around. People thought that was going to be just a total disaster. I shouldn't say everyone, but it seems like half our client base thought that was going to be a huge economic disaster. The market was going to tank. Then we have 8 great years in the stock market while Obama's president. Then, and when Trump gets elected, the other half of the clients were bent out of shape, thought it was going to be a disaster, thought the stock market was going to tank. And then up until recently, we had great market performance, and we're still up substantially from when he was retired, even now after the decline. So trying to predict how the market will react to an election is just impossible. And it seems like regardless of which political party gets elected, the market tends to go up over time because really smart business people find a way to increase their profits over time.
Well, and what tends to, go ahead, Ryan.
I was just simply going to state that I think most people put way more emphasis and weighting on the president's impact on a financial market system when we have just the S&P 500 being 500 individual companies. People will immediately look at, where was the S&P on this date when this president was sworn in, and on this date when he left, or maybe in the future she, and they assume automatically that it's correlation that president had direct impact on the returns from start to finish, when it's merely just 2 overlapping events that occurred at the same time. The president was the president during this period of times. There was infinite number of events, world events, domestic and international, that happened all at the same time. And we came out on the other end, and this is where the S&P, for example, finished up. So I think there are policies that could potentially have impact, of course, on any performance over any given time, but people put more emotional weight than is actually really driven out in the data based on their being in office has a direct impact on the market. It's minimal at best.
I am in the camp of believing that the Federal Reserve will do extraordinary things in a presidential election year. I think history shows that out pretty well, but they can only do so much for so long. Before Bernie Sanders became not going to win, going into basically Super Tuesday, which wasn't that long ago, there was a lot of concern by a lot of different types of companies, predominantly healthcare companies, that if he won, they might have a harder time. And, United Healthcare, when it became clear at the end of that day, it wasn't going to be Bernie Sanders, United Healthcare went up 11% overnight. The good news is nobody knows what's going to happen, but here's the important thing. We're dealing with capitalism, and as long as we stay relatively capitalistic, we can have arguments that it's crony capitalism, et cetera, but predominantly a capitalistic system. And regardless of who's in the White House the next day after the election, everybody gets back together and says, okay, time to go start building that iPhone 12, make it better and cheaper. And these great managers, intellectual entrepreneurs, they just look over their shoulder, see what the rules are, and they go do the best they can with those rules. But nobody's going to stop the innovation. We can slow it down. We can impair it. We can speed it up based on regulations and rules and policy. But you're never going to stop it. And really, the only thing that matters to investors, you take retirees, we've already thrown out the idea that you could be 100% fixed income. For most people, that's not even going to come close to working out. That's a disaster on the installment plan, which then says, okay, then we're going to have a portion of our portfolio and ownership of the great companies of America and the world. And you got a pretty big group of really brightest and the best in some cases people managing those companies, trying to produce increased earnings, increased revenues, increased dividends, and if all those things happen, you get increased stock prices over time. We just don't know whether it's going to be 10%, 4%, 14%, and that's unknowable, and it's irrelevant. The only part that's relevant are I'm in an asset class where really bright innovators and intellectual entrepreneurs are doing the best they can to create shareholder value. And in the aggregate, history says, in the aggregate, people that invest in the great companies of America and the world have earned 2 to 3 times the return to the people that buy their bonds. That's the story. And those returns, you know, as big as they have been, as beneficial they've been to society, they do ask for something in return. Your ability to keep your head when others can't. And that's usually going to come in depressing times, but not always. Sometimes it's going to happen during periods of irrational exuberance. That's the key. That's the whole banana right there. And it's just saying, look, we don't know what's going to happen. The owners of the managers of the companies don't know what's going to happen politically, but that's not going to stop them.
Yeah, sort of on the same note of companies that are going to have to deal with some hardship and kind of innovate. A question that came in is actually about, you know, with the impact of everyone working at home and not really going to an office anymore, you know, is that going to cause trouble for REITs? And is that maybe something we should avoid at this time? What are your guys' thoughts on that?
Paul, I know when we drove around Texas, you like real estate. And one of the things that I still remember you saying is, you know, you'd say, look at that strip mall or that strip mall. Those are the kinds that are going to get blown up in the first economic contraction. I got to imagine that's going to speed up pretty fast. I'm going to just make a quick point, and I'd almost be interested to see the feedback from clients. Even though I'm the old geezer of the family, it's my view that what I've learned out of this is I don't think we necessarily need Ruedi Wealth Management needs a big office building. It's not big that we have, that we can have a meeting place for our clients and operate just fine. We're not going to do that from what I've already been outvoted on that one. But it makes me wonder, that's a great question. Dave, I want you to think about that from an asset class standpoint. Does that mean REITs, which are real estate investment trusts, which are 10% of our US holdings? Should that just, I mean, you could connect some dots and say, well, therefore, maybe we don't want to be in real estate investment trusts. Is that healthy to even think that way?
So I wrote an article about this, not this specific issue, but conceptually, I think it addresses this. Is anytime you have an investment theory or idea, even if it sounds really reasonable, you have to ask yourself, well, what do I know that the market doesn't already know? So maybe, and I probably agree with him that there's going to be a negative impact on real estate. I do think it just seems intuitive that some people are going to say, especially people in New York who have just outrageous rent, maybe I don't need to be spending $100,000 or whatever it is on an office building when I can work from home. So you would think there's going to be a negative impact. The issue is we're not the only ones who think that. We're not the only ones who know that. I'm sure a lot of people share that sentiment, and that's why REITs are down. And they're still down. I think I just looked about like 20% from the beginning of the year. So going forward, you don't know how the returns for REITs will be relative to any other asset class because they've already kind of been beat up for that reason.
And I think there's also winners and losers and everything too. You know, like if you own a Dollar General, for example, a building that has a Dollar General in it, well, a Dollar General is really well positioned for an economic downturn. You know, that's not the same as owning, you know, some type of, I guess, kind of a more fad store or something like that. You know, there are certain parts of real estate that are still going to be safe. You know, for example, Walgreens, they do their real estate deals on like 40-year leases. So unless Walgreens goes broke, those real estate assets are going to be fine too. So it's not like real estate in the aggregate is just going to be a dumpster fire, but I wouldn't surprise me if office takes a big whack. I mean, I think people are very much learning that not only can they work from home, they might prefer it. I know Ryan doesn't with 2 young kids, but a lot of people do.
Oh, in other words, Dave, it's already priced in. Chances are now everybody's making bets, right? And that's where prices end up and go to their equilibrium. But it's kind of an important point. It's kind of like, yeah, the 4 of us or the 5 or 10 of us that are listening today aren't the only ones that have thought of this. It's the billion overlapping minds. And those expectations are, whether it's the worst case scenario or the best, somewhere on that spectrum, people have placed their bets as to where real estate's headed. So it might, it could be less worse than people thought. That's going to increase prices. It might be worse than people thought. And then real estate prices, well, let's just admit that you can't really build a strategy out of looking at an asset class saying, I think A is going to happen, so therefore we should do B and C.
Yeah, and that's almost exactly what I was going to say is when you have to think about, well, what moves market prices? And it's right now, the current market price is kind of like the aggregate of investors' minds. It's their best guess of how things might play out in the future. But it is, that's all it is it's the best guess. So then what happens is new information comes out, and if it's better than what people were expecting, then the market could go up. If it's worse than what people were expecting, it could go down. So that works on a smaller scale too. You think of real estate, okay? The aggregate of investors and REITs have a certain prediction for the future based on what we know today. If things end up being worse than what people already expect, yeah, you could see them fall further, but they could also end up being not as bad as what we expect, and you could end up having really strong returns in REITs. And I think that always trips people up is sometimes you hear this is the case, and therefore, like the example I've used with friends, because I've noticed people make this mistake, is they just think a good company means that it's a good investment. So it's like a good, healthy, financially healthy company is going to be a good stock investment. That's not necessarily the case because its price already reflects the fact that it's a good company. That always messes with people's minds. You have to know the price relative to the information that's out there to know whether or not something's a good investment. And you never know how the future's going to play out.
Yeah, I mean, everybody knows a great company when they see it. I mean, we all might differ about the extent of greatness, but in a general sense, we know what an excellent company looks like. So does everybody else. And guess what? It's safer to own. And investments that are safer don't come with higher returns over time. So risk and return are always connected. So, other than speculation, I think something's going to happen and nobody else knows it. And so therefore I'm going to buy it. It's all factored in. Having a great diversified portfolio. The other thing is, we don't know. I couldn't tell you. Maybe you guys can't. I don't know which one of our asset classes are going to shoot the lights out compared to all the other ones over the next 5 or 10 years. One of them's going to, and it's probably not going to be one we saw coming. So it's not that we just don't know which things aren't going to work. We don't know which things are going to work either. The S&P 500 is 500 companies, but I assure you, the broad U.S. market, if you just look at the Standard & Poor's 500 index, is doing a lot better than everything else. Simply because, like Paul said, there's always winners in these things too. And it turns out in this debacle, the largest, more growth-oriented companies in the S&P 500, the handful of them, are driving most of the good news. Most of the up market rebound here has not come from probably 95% of the others.
Well, speaking of some of the winners and losers in all this, actually our last question, unless someone asks another one here in just a second, is, why are food producing companies like ADM, I'm not exactly sure what company that is, I think.
Archer Daniels Midland.
Okay, gotcha. Well, I don't know them by their ticker symbol.
It's based in Decatur.
Yeah, why are they not doing well, I think is the question here.
I don't know. I'd have to think through it. Probably have less demand for food. I mean, people are going to eat, but they're not maybe I can make a case people aren't going to a restaurant. I mean, that's just going to shift the logistics of certain types of commodities are probably going to have different impacts. I'm sure meat packing companies are probably doing better, maybe.
So I can actually weigh in on that because my fiance's dad actually works for Cargill here at one of the largest hamburger processing plants in the country. And an interesting thing when all this started, you know, they were doing great for a while, but then their demand dried up a little bit. And they had actually shut down a couple of their floors of production, not because of the coronavirus, but because, you know, they supply Burger King and Sonic and these companies that they just weren't purchasing as much meat. I know another issue is, you know, meat processing in particular. You have people in line standing, you know, right next to each other, shoulder to shoulder. And if there's any sort of mandatory social distancing, that just really can't persist. So I think they have to kind of deal with how are we actually going to produce the food that we've been producing in the current social distancing environment, if we even can.
Yeah,
So
part
I'd
of
have
it
to say
might
that's
just be a story of cost, right? Even if we're doing the same thing, same demand and everything, the cost of running a company, a big company, has gone up just because of all the health precautions and all these other things you have to take. So even if you had the same amount of gross revenues, your costs have probably gone up. And it's not as if people wake up one day and there's suddenly a big increase or decrease in demand for generically food, but maybe being at home a lot. I think I'm eating more. So I don't know, it's shifting. That's a good question. I guess it gets back to nobody really knows. There's always an eloquent story, but we usually figure that out after the fact and make it up as we go, as analysts or pundits do. Okay.
Well, that's the end of the question. So do you guys have anything you want to say just as kind of final thoughts here?
No, thanks for everybody for joining us. We're going to keep doing this and hope you enjoy it. And we should probably open it up to see if there's even a need for public that, you know, if they'd have any interest. Give us your constructive feedback, whether this is valuable or not valuable. You can't hurt my feelings. Anybody else have anything to say?
I think that's it. Oh, Dave does.
I'll add one ending note because I've just, and this has kind of been an overarching theme for this webinar, is just that at a certain point, I think you do have to admit you can't time the market and just say, like, make that decision in your mind to say, I am not going to try to time the market, because I've noticed a lot more people, for whatever reason, during these last few months, it's like everyone's becoming a market timer and trying to predict what the market's going to do and whether now is a good time to invest, or should they shift their portfolio from this to that. And things just become a lot less stressful and a lot simpler when you just say, I admit I cannot predict the market. I'm just not going to play that game, and I'm not going to attempt to time the market. I'm going to stay diversified, and I'm going to stay invested no matter what's going on. So that's just, like I said, an overarching theme for this call that I think is just important to hit head on.
I think too, it's one single event, one single person, or one single bit of information is not going to drive market prices. It's all the information across the world. It's all the people in their overlapping minds driving market prices. So one single bit of information it's easy to go, I know that this person did this and it affected the market, or this single bit of information affected the market, but it's really a lot more complex than that.
So Daniel, I noticed there's a question about, they said, ask Daniel for a fishing report.
A fishing report? It's been pretty good lately. I found out that a lot more people love fishing right now because there's nothing else to do. So the pressure's been up, but I mean, it's a good time of year, especially here in Texas. I mean, in Illinois, it's probably the best time to fish right now. Fish should be shallow.
Are you in tournament time yet?
Yep. I got a tournament in 2 weeks. They're finally starting to have them again. The social distancing thing is interesting because you usually are standing close to each other weighing in fish, but they're going to do like a carousel line where I'm just going to like hop off, weigh my fish, and then hop back on the boat and keep driving. So everyone's adapting, even the tournament fishermen.
All right. Well, I appreciate everybody joining us today.
Yeah, good deal. Thanks, everyone. Thanks for all your questions. And hopefully Daniel will have a good report for us the next time we have these office hours.
Yeah.
Take it easy, everyone. Bye-bye.